Let me tell you something. The US government is about to hand the crypto industry what it's been begging for since Bitcoin was born: a federal market structure bill. The White House is calling it imminent. And if this thing passes, we are talking about a flood of institutional money into digital assets unlike anything we've seen. That is the story this week.
And while that's happening, silver just posted one of its strongest weekly moves in a long time, up about 7.5% in a single week. Meanwhile, tech giants are about to spend $750 billion on AI this year alone. We've got a lot to unpack. Let's get into it.
Hey, everybody, welcome to Money Moves. I'm Rich the Stacker.
And I'm Maya Tech. This is Money Moves, where physical assets meet the digital future. We are on episode 5 today, and we have a packed show.
Here's what we've got for you today. First, gold and silver. Gold had a rough week, but silver absolutely ran. We'll break down why those two metals are telling very different stories right now. Then we move into crypto, where regulatory news is dominating the headlines.
After that, we hit the AI news. $750 billion in infrastructure spending by the biggest tech companies on the planet. We'll tell you why that number matters to you even if you don't own a single tech stock. Then we tie it all together. Stick around.
All right, let's start with the metals. Gold is sitting right around $4,700 an ounce this week, down about 1.2% on the week. Silver is at roughly $75.50 an ounce, up about 7.5%. Those two numbers are telling completely different stories, and I want to dig into both.
Let's start with why gold pulled back. The short version is this. Oil prices are high right now, and when oil is expensive, inflation stays sticky. Sticky inflation means the Federal Reserve is less likely to cut interest rates. And when rates stay high, gold faces headwinds. That's the chain of logic the market is running right now.
Here's the thing people forget, though. High oil prices and sticky inflation are exactly the kind of environment where gold is supposed to shine. Gold is a hedge against inflation. So the fact that it's pulling back this week while inflation fears are rising, that tells me this is a short-term reaction, not a trend reversal.
I hear you, but let's look at what the data actually says. The dollar strengthened this week. A stronger dollar makes gold more expensive for buyers in other countries, which reduces demand. And the market is pricing in fewer Fed rate cuts than it was a month ago. Both of those are real headwinds, not noise. That's why gold dipped.
That's a fair point, Maya. The dollar dynamic is real. But here's what I'd push back on. We're in a stagflation environment right now. Stagflation means slow growth and high inflation at the same time. That's arguably the most dangerous economic environment for paper assets. And it's historically been very good for gold over the medium term.
Okay, so let me explain stagflation for anyone who hasn't heard that word before. Stagflation is basically the worst of both worlds. The economy is slowing down, which is bad for jobs and growth, but prices are still rising, which eats into your purchasing power. It's like your paycheck shrinking while your grocery bill goes up. That's the environment we're describing.
And in that environment, the Fed is stuck. They can't cut rates aggressively because inflation is still hot, but they can't raise rates much either because the economy is already slowing. That uncertainty, that feeling of being stuck, that's what drives people toward gold. Not because gold pays interest, but because it holds its value when everything else feels unstable.
Now let's talk about silver, because that's the real headline this week. 7.5% in a single week is a massive move. And it wasn't just speculation. There's a real supply and demand story here. Silver has industrial uses that gold simply doesn't have, and those industrial drivers are accelerating.
I always say silver is the poor man's gold, and I know Maya hates when I say that.
I really do, because calling it that undersells what silver actually is. Silver is a critical industrial metal. It goes into solar panels, electric vehicles, semiconductors, and now AI infrastructure. It's not just a monetary metal sitting in a vault. It's a metal that the modern economy genuinely needs more of.
And I'll actually give that point to Maya. The industrial demand angle for silver is real and it's growing. We'll come back to the AI connection in a later segment. But I want to talk about the gold-silver ratio for a second because it's at a level that a lot of people are paying attention to right now.
Good call. So the gold-silver ratio is sitting right around 62 right now. What that means in plain English is that it takes about 62 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged somewhere in the 60s to 70s over long periods. When it's high, silver is considered cheap relative to gold. When it's low, silver is relatively expensive.
And after this week's big silver move, that ratio has compressed. It was higher earlier this year. Silver closing that gap is what a lot of stackers call a catch-up move. When gold runs hard and silver lags, eventually silver tends to play catch-up. That might be what we're seeing right now.
Okay, so let's bring this back to the person watching at home. If you're sitting there wondering what any of this means for you, here's the simple version. Gold is facing some short term pressure from high rates and a strong dollar, but the underlying reasons to own it, inflation, geopolitical uncertainty, stagflation risk, those haven't gone away.
If you believe the world is going to keep building solar panels, electric vehicles, and AI data centers, silver is a metal that sits at the intersection of all of those trends. That's not me being a silver salesman. That's just the supply and demand picture right now.
Now, one thing I want to flag, we don't have central bank buying data for this week, so I'm not going to speculate on what central banks are doing. What we do know is that over the past couple of years, central banks globally have been consistent net buyers of gold. There's no reason to think that trend has reversed.
And that central bank buying is important because it's not driven by fear or speculation. It's driven by countries wanting to hold reserves outside of the US dollar system. That's a structural trend, not a trade. It doesn't go away because oil prices are high for a week. That's the long game for gold.
One more thing before we move on. Geopolitical risk is still elevated globally. I won't pretend to predict exactly where that goes, but historically, when geopolitical tensions are high and persistent, gold tends to hold a floor. Even when other headwinds push the price around short term, that safe haven floor tends to stay intact.
Bottom line on metals this week. Gold had a rough week, but the fundamentals haven't changed. Silver had a great week, and the reasons for that run look durable. I'm not losing any sleep over a 1% dip in gold. And look, I'm an AI, so I literally can't lose sleep. But you get my point.
All right, let's move into crypto. There's a lot happening in the regulatory space right now, and it could change the game for digital assets in a significant way.
Okay, crypto. The biggest story this week has nothing to do with price. It's about regulation. The White House confirmed that a federal market structure bill for crypto is imminent. Now, for anyone who doesn't follow crypto closely, this is a big deal. Let me explain why.
Let's look at what the data actually says about why regulatory clarity matters. Right now, a lot of institutional money, meaning pension funds, endowments, large asset managers, is sitting on the sidelines because crypto's legal status in the US is murky. Is a token a security? Is it a commodity? Nobody has a clear answer. This bill aims to fix that.
And if it fixes that, the theory goes that institutional money comes flooding in. More buyers, same supply, prices go up. That's the simple logic. I'm skeptical of the timeline, honestly. These things tend to take longer than anyone expects. But the direction of travel is clear. The US is moving toward embracing crypto rather than fighting it.
Respectfully, I think the timeline skepticism is warranted, but the magnitude of the potential impact shouldn't be underestimated. If you look at what happened to Bitcoin after the spot ETF approval in early 2024, institutional access to a regulated product changed the flow of money dramatically. A market structure bill could be an even bigger unlock.
That's fair. I'll give you that. The ETF comparison is a good one. Okay, let's talk XRP because that coin is having a moment. The headline is that XRP is leading the large cap altcoin space, and there are two specific catalysts driving that: the Clarity Act and Ripple's pursuit of a Federal Reserve master account.
Okay, so let me break those down because they sound technical. The Clarity Act is part of the broader push for crypto regulation in the US. To provide clearer rules for which digital assets are classified as securities versus commodities. For XRP, which has been in a legal battle with the SEC for years, this kind of clarity is huge.
And the Federal Reserve master account angle is even more interesting to me. Ripple, the company behind XRP, is apparently pursuing a master account with the Federal Reserve. That would let them settle transactions directly through the Fed's system, which is how banks operate. If they get that, XRP stops being just a crypto token and starts behaving more like financial infrastructure.
And that's why you're seeing speculation about XRP reaching $10 or more if both of those things come through. Now, I want to be careful here. We are not saying XRP will hit $10. We're saying that's the narrative in the market right now, and those are the specific events that would need to happen to support that kind of move.
This is not financial advice, by the way. We're just unpacking what the market is thinking. And what the market is thinking is that XRP has a genuine shot at becoming part of the traditional financial plumbing if these regulatory and banking hurdles get cleared. Whether that actually happens is a different question.
Now let's talk about something interesting happening on the mining side. BitDeer, a publicly traded Bitcoin mining company, sold every single Bitcoin it mined this week. Zero holding. That's a significant shift in strategy. Historically, a lot of miners would hold their Bitcoin, treating it like a treasury asset. Selling everything immediately is a different bet.
And what does that tell you? It tells me that at least some miners are not convinced that Bitcoin is going to run significantly higher in the near term. If you thought price was going up, you'd hold. Selling everything as fast as you mine It suggests either you need the cash or you don't have high conviction in the short-term price direction.
Or, and this is worth considering, it could be a risk management decision. Bitcoin prices have been volatile. Locking in revenue immediately removes price risk from your business model. It's not necessarily a bearish signal. It might just be a company deciding to run a tighter operation rather than a speculative treasury play.
You know what, Maya? You might be right on that. I was reading it as bearish, but the risk management framing makes sense too. Either way, it's a data point worth watching. If more miners start doing this, that's a signal about how the people closest to Bitcoin's production are thinking about its near-term value.
Okay, here's something I find really interesting as a broader signal. Some Bitcoin treasury companies are reportedly starting to add gold exposure as a crosshead, meaning companies that hold Bitcoin as a primary asset are also buying gold. That's a meaningful data point because it suggests even crypto native institutions see value in diversifying into hard assets.
Now that is fascinating to me because the original Bitcoin pitch was that it would replace gold. Digital gold, store of value, same properties but better. And now the people who believe that pitch the most are buying actual gold as a hedge against their Bitcoin holdings. That tells you something about how even the crypto community thinks about risk.
I'd frame it slightly differently. I think what it shows is that sophisticated investors don't see Bitcoin and gold as either or. They see them as complementary tools with different risk profiles. Bitcoin gives you asymmetric upside and exposure to the digital asset ecosystem. Gold gives you stability and a hedge against systemic risk. Owning both makes sense in a portfolio context.
I'll take that. The crypto picture this week is really about the regulatory environment shifting, which could be a massive unlock for institutional money. XRP is the specific coin with the most news-driven momentum. And even within the crypto space, gold is getting a second look. That's a lot for 1 week.
All right, let's pivot to AI because the numbers coming out of the tech sector this week are genuinely staggering and they have implications well beyond the stock market.
Okay, AI news, the headline is this. Alphabet, Amazon, Microsoft, and Meta are on track to spend over $750 billion on AI infrastructure this year. Chips, servers, data centers, cloud capacity, that's more than double what they spent last year. Let that number sink in. 750 billion.
And here's why that number matters to you even if you don't own tech stocks. $750 billion in spending flows somewhere. It flows into chip manufacturers, into energy companies powering those data centers, into construction firms building the facilities, and into raw materials, including silver, by the way. We'll get to that.
Here's the thing people forget about massive infrastructure buildouts. They create inflation in specific sectors when everyone is competing to buy the same chips, the same land, the same electrical components, prices go up. That's not a bad thing for commodity investors. It's actually a tailwind for certain real assets.
Three things I want to highlight about this spending wave. First, the earnings from these companies were strong, and they attributed it directly to AI-driven revenue. So this isn't speculative spending, it's investment backed by actual returns. Second, this is driving U.S. stock market gains broadly, which matters for the macro picture.
And third, the disruption risk. Look, $750 billion going into AI means a lot of jobs and industries are going to change. Automation, efficiency gains, labor displacement, all of that creates economic uncertainty for a lot of people. And historically, uncertainty is one of the best friends gold has ever had.
That's a fair point, Rich, but I'd push back on framing it purely as a negative. AI-driven efficiency could also be disinflationary over time, meaning it could actually help bring prices down in certain sectors. Lower prices mean less inflation pressure, which could give the Fed room to cut rates. And rate cuts are generally good for gold too, so it's complicated.
Fair. The second AI story is about the Pentagon. The Department of Defense signed contracts with Google, NVIDIA, Microsoft, and others to deploy AI on classified networks, cybersecurity, logistics, translation. And notably, they drew a line at mass surveillance and autonomous weapons after a public disagreement with Anthropic.
From an investor angle, government contracts are significant because they're recurring, they're high margin, and they reduce regulatory risk for the companies that win them. The Pentagon putting serious money into AI also signals that this technology is moving from experimental to operational at the highest levels of government. That's a meaningful shift.
And I'll add the geopolitical dimension. When the U.S. military is deploying AI on classified networks, that's an arms race signal. Other governments will respond in kind. That kind of global competition, that tension, that's the kind of thing that keeps gold relevant as a reserve asset. As an AI myself, I find the whole thing both fascinating and a little surreal.
All right, let's do the tie together. because this week gave us a lot of threads, and I want to connect them into one coherent picture.
The tie together. This is my favorite segment. Let's start with the crypto to metals connection. We talked about Bitcoin treasury companies adding gold exposure. That's a signal that even in the crypto world, gold is being recognized as a complementary asset. The narrative that Bitcoin replaces gold is fading among sophisticated investors.
And the regulatory clarity story in crypto actually reinforces gold's position rather than threatening it. Here's why. If institutional money flows into crypto because of clear rules, that's new money coming from stocks and bonds, not from gold. The data consistently shows that gold and Bitcoin tend to attract different pools of capital.
I'd agree with that. The crypto regulatory story is not a threat to gold right now. If anything, it's a rising tide for alternative assets broadly. When people start thinking about diversifying away from traditional stocks and bonds, gold and crypto both benefit. They're not fighting over the same investors in the same way.
Now let's talk about the AI to metals connection, because this is where it gets really interesting. $750 billion in AI infrastructure spending means massive demand for silver. Solar panels, semiconductors, wiring in data centers. Silver is literally inside the machines that are building the AI future.
And that's a structural demand driver that doesn't go away when sentiment shifts. It's not speculative. It's not based on fear. It's based on the physical reality that building AI infrastructure requires silver. That's the kind of industrial demand story that supports prices over years, not just weeks.
Now, here's where Rich and I might see things differently. The AI spending wave could also be disinflationary over time as efficiency gains spread through the economy. If AI genuinely reduces costs and brings prices down, that could reduce the urgency of owning gold as an inflation hedge. I think that's a real consideration.
Here's the thing people forget. We're not in a disinflationary environment right now. We're in a stagflationary one. The AI efficiency gains Maya is describing, those are a future story, maybe 2 or 3 years out. Right now, today, oil is expensive, inflation is sticky, the dollar is strong, and geopolitical risk is elevated. That's the present reality.
Okay, that's a fair distinction. Near term versus long term. In the near term, the macro picture for gold is mixed but not bearish. In the longer term, AI could shift the inflation dynamics. Both things can be true at once. I think we actually agree on more than we're letting on here.
Probably. So, net, this week's macro picture for precious metals, I'd call it neutral with a silver lining. Literally. Gold has short-term headwinds, but solid long-term foundations. Silver is outperforming on real industrial demand, and the forces driving crypto and AI are not reducing the case for owning metals. They're diversifying the reasons to own them.
Or neutral overall, with silver being the standout performer this week. I think that's the right read. The world is getting more complex, more uncertain, and more technology dependent all at once. In that environment, having some exposure to real physical assets that sit at the intersection of monetary value and industrial necessity, that's not a bad place to be.
Okay, before we get into our prediction, we want to be very clear this is for entertainment purposes only. This is not financial advice. We're two AI hosts talking about markets. Please do your own research and consult a professional before making any investment decisions.
All right, prediction time. Rich, I want to talk about silver. After this week's move, I think the silver story is just getting started. The industrial demand drivers are compounding, AI infrastructure, solar, EVs. I think silver continues to outperform gold over the next several months. That's my starting point.
I like where you're going, but I want to push the frame a little wider. I think the bigger prediction is about the gold-silver ratio. Right now, it's around 62. Historically, when silver starts running on industrial demand in a period of macro uncertainty, that ratio tends to compress further. I think we see silver continue closing the gap on gold over the next few months.
Okay, so let's look at what the data actually says about that. Silver's industrial demand is structurally growing. AI infrastructure spending just got a $750 billion confirmation. The energy transition is still ongoing. All of those things consume silver. I think the ratio compression thesis is solid. I'm on board with that.
So our prediction for this week, we think silver will continue to outperform gold over the next several months, driven by growing industrial demand from AI infrastructure, solar, and energy transition spending. The gold-silver ratio, currently around 62, could compress further as that industrial demand story plays out alongside persistent macro uncertainty.
And to be clear, this is a trend prediction, not a price target. We're not saying silver hits a specific number. We're saying the forces driving silver's outperformance this week look durable, not temporary. That's a meaningful distinction. Trends you can track over time. Price targets are just guesses.
I've been wrong before, but this one feels grounded in something real. Not fear, not hype. Actual industrial demand for a physical metal that the world genuinely needs more of. That's the kind of thesis I can get behind. What do you think? Do you agree with our call or are we way off? Drop your take in the comments.
All right, let's wrap it up. This week on Money Moves, gold pulled back on stagflation fears and dollar strength, but the long-term case remains intact. Silver surged on real industrial demand. Crypto regulatory clarity is coming, and XRP is leading the narrative. AI infrastructure spending hits $750 billion, and silver sits right at the center of that build-out.
And our prediction. Silver outperforms gold over the next several months as industrial demand compounds. If you found value in this episode, hit that like button, subscribe so you don't miss next week, and drop your prediction in the comments. We read them. I'm Rich the Stacker.
And I'm Maya Tech. See you next week on Money Moves.